Stanlib manages over 365 billion rand of assets for over 400,000 retail and institutional clients. It has a presence in 8 African countries. Stanlib's value fund aims to generate medium to long-term capital growth for investors with income generation as a secondary objective. So Shawn Stockigt, value fund manager at Stanlib, joins us from our Cape Town studios to share their investment strategy. Value, it's a big word and it's a broad word, Shawn. What does it mean for you?
Yeah, I suppose that's exactly the point. Value is definitely in the eye of the beholder. So I suppose it takes on how one looks at it. For us as a value franchise, share prices change from day to day, which we well know, but the value of a business remains relatively static. So I suppose if one spends one time to try and understand the true value of a business, then one can take advantage of those share prices from day to day or in the market. Now, how one determines value, obviously various parties differ on that. We understand that the value of a business is a future cash flows discounted to the present value. We accept that. We just have a problem with trying to forecast those future cash flows. So we tend to say, well, hang on, we'd rather look at what the value of the business is currently, very similar to private equity, and say to ourselves, in a growing economy, what would it cost to replace this business? And in a declining economy, what would it cost to liquidate this business? So generally, we rebuild the balance sheet. So if we take, for example, a City Lodge, the accounting valuation or price or book value of City Lodge would be sort of in excess of about 9 rand, whereas the true reality value of City Lodge to replace that business would be where the current share price is. So we just really rebuild the balance sheet to take into consideration economic reality.
Shawn, Ashraf here, the one challenge that you do face is that value sometimes takes a while to unwind, and you could be buying City Lodge, as you mentioned, by example, at a 40% discount to your fair value, but it could remain at that 40% discount for a period of 12 to 18 months. Are you comfortable holding that and having a stock like that holding back your performance?
Yeah, I think that's exactly the point, and obviously that's the kind of person who invests in that fund, understands that, and understands that unlock of that value, as you rightly say, might take years. It might be unlocked on day one. It just depends what that is. But as long as you understand what that value is, and you're not dogmatic in it, but you understand what it is and you understand what the catalysts are for that, eventually the market will react to that, or the company will be taken out if it's ridiculously cheap.
And when one looks at value, when we were discussing retailers earlier, that certainly does not come into your purview. Which sectors would you be looking at right now?
Yeah, no, we've been underweight retailers for a while, and admittedly it's cost us because those retailers have just continued to climb. And they're good businesses. I mean, you look at those companies, they're very good businesses, but the valuations are a little bit stretched. So, and if you go back, say, to 2008, where retailers were completely depressed because we had the Credit Act coming into existence, etc., and construction companies were at extreme highs, it's the complete reverse at the moment. So something has to give somewhere. So we think that construction is starting to look cheap and offer value, and also the defensive, the diversified miners. Because if you look at where the resource sector is currently, and you just use PE relatives, for example, there's only about 3 times since 1968 where resources have been at this current level. Now we know there's problems, and we know that there's slow growth in Europe. We know that the Chinese growth, but I guess one's trick is to try and identify how much of that is being priced in, because the market does tend to overreact, and how much patience you have to take that.
Yeah, Shawn, you talk about resources, and it's a good way to get into platinum. And in the past couple of weeks, with that sector taking a knock and closures, the sector is adjusting. The market is adjusting. The supply is too great. There's a surplus in the world market, so there's a cutback in production. So to what extent is your value approach, where you talked about particular companies, is it affected by the sector? Because you could say with platinum, for example, down the line, eventually, there is going to be demand again for more cars, catalytic converters, and therefore platinum. So even if a company is getting a big hit now, down the line, it's surely a value proposition.
No, exactly that. And I think, we don't know, as I said, we can only spend our time trying to understand what the value of that business is. So we don't know when that re-rating will come, and it might even fall further. We don't know that. But as long as we're buying it at or below its current value, and if it falls further, it just gets cheaper. It doesn't get more and more expensive, it just gets cheaper. Obviously, if something fundamentally changes within that business, and that's a different story. But if one just looks at, the diversified miners, as I mentioned, and at this stage, we tend to think that exposure can be taken there rather than going into the platinum miners at this junction, because you get exposure to that as well, but you get more geographical exposure, and as well as a more diversified exposure of commodities. So you're taking, I suppose one could argue, slightly less risk, and where the current valuations are, it makes sense for us.
We talked earlier about our banks and that they might be of interest to foreign investors in the same way that our retailers have been. There's a sector, a financial sector in South Africa, which is well regulated, a very high reputation. Within the sector, of course, you have different operations, different kinds of business models. A FirstRand, for example, decentralized model compared to the other three, which are more centralized. How do you approach that sector and those institutions with your philosophy?
No, 100%. Again, we bottom-up driven, so we'd go for the cheap. The unfortunate things with a bank is that as we've seen with Sambo in the early 90s, is that, early 2000s, is that a book value of a bank can unwind very, very quickly. So for banks, for example, you may not want to necessarily be in the cheapest, but you want to probably be in the soundest. In other words, one of the better geographic spread, and as well as a more diverse product base as well. So we can apply that to it, but looking at the banks, the banks have, although they've underperformed the industrial sector since 2008, 2009, and even going back to 2003, some of the banks have reacted quite aggressively upwards. And admittedly, rightly so. I mean, FirstRand has come up with incredibly good results, especially with Westbank doing extremely well. But there are, in other areas, sort of Able, the financial services such as Able, etc., which still has a whole lot of restructuring to come through. And Investec, for example, a couple of weeks ago was trading at its private bank and asset management valuation. So you're getting the rest of the operation for free. So within that sector, I suppose one can take a view, well, financial services are fair priced, but within that sector, there's still pockets of value.
Shawn, just to go back to your opening statement, you mentioned that, if I understood it correctly, that cash flows weren't as critical as the underlying value. There are some value managers who believe that, the collection of dividends is important. So how do you breach that gap between yourself and the other managers?
Now, the free cash flow is very, very important for us. So the first leg is understanding the liquidation replacement value, and then we'd move on to the income statement and calculate that earnings power value and try and determine what if this business, because we want growth in a business, we just don't want to pay for it. So we want to determine if this business stopped today and continued operating in its current format. In other words, it didn't grow any more from where it currently is. How much can you extract from that business? And from that aspect, obviously, that free cash flow is very, very important to us. Also bearing in mind that from a growth perspective, one can ask management where they incentivize, and if they tell you they incentivize on earnings per share, then they're probably going to grow the income statement through acquisitions, etc., and utilize that cash. Now, history has taught us that management generally does not allocate capital efficiently, and I generalize here. And you could probably have done better by getting that cash paid out to the shareholders and then investing it in a better area. So we obviously, dividends and etc. are very important to us.
Shawn, your philosophy, your approach, at a time like this, a lot of the markets, a lot of investors hanging back a bit, there's a lot of cash sitting around, people are waiting and seeing, but there must still be opportunities. So at a time like this, isn't this a great opportunity? If you've got a consistent philosophy, there must be investments that match your criteria, and what sort of thing would you be going after now?
Well, I think that's exactly it. You don't find cheap companies you don't find great value in great environments. So often one has to try and ignore the noise and put emotions aside and just focus on the valuations. And as Ashraf said earlier, that can take a little bit of a while to unravel. We have seen, and the value fund has increased its mandate to invest offshore. So we have started seeing value in the UK and the US market. So we started taking a very slow approach in investing over there. I mean, for example, you look at a Tesco's, which trades at a single-digit multiple, close to its price to book, still generating about 17% in return on equity, has about 30% of the UK market, and you compare that to the likes of a ShopRite, and you can see that there might be potentially value there as well. So And as I said earlier on, the diversified miners are now starting to look attractive, and one can't ignore them for much longer. You know, the controversial call would probably be to look at the likes of a Telkom. We understand the uncertainties with regards to Telkom. We understand all the negativity around Telkom. But at some point, that's got to be priced in. And that's what our job is, I suppose, to spend a lot of time trying to understand what is priced in and what can you potentially get out of it.
Well, I suppose that Telkom is a classic example of the noise around a particular company for various reasons. They had bad results, they have the cabinet blocking a deal, and there's a lot of noise, but as you say, you look beyond that. Just to get back to the banks, FirstRand model, there will be pressure on banks. It's mounting in Britain certainly to separate the traditional banking business, deposit taking, lending and that sort of thing, from the money making, the investment stuff, which is rather different, and talk of splitting the model. In that light, a bank like FirstRand would be almost ready for it in the sense that it is already decentralized, whereas the other banks would have a lot more work to do.
Yeah, I suppose that is true, and that will probably be the next theme for people to start looking at and seeing what's happening internationally to domestically. But I mean, our banks are you know, despite all the noise, our banks are well capitalized. In some cases, too well capitalized. So very sound operating models generally across all the banks. You know, I think this little hiccup we've seen with ABSA mustn't be pulled through to the rest of the banks, and I think one must wait till the results come out before one makes a decision on the whole sector.